Hello, guys, and welcome back to the channel. Thank you, guys, for always coming back. If you're new here, you're most definitely welcome. Hello, hi. My name is Anita. We do all things personal finance, self development, and self growth tips. If this is the kind of content you're interested in, please do me the favor of clicking on the subscribe button down below to get subscribed and join my amazing family. Do share with your family and friends, and share the channel with your family and friends. Let them get to also know about it and get educated. Check out my previous videos, guys, and I would definitely love to hear from you in the comment section down below. Give me a massive thumbs up if you love this video. In this video, we'll be talking about the smartest way to actually kickstart your investment journey in this year. A lot of people have fears, most especially about losing their money when it comes to investment, and some also think that it is for the rich. But we're here to debunk all these things. Investment is for each and every individual. You just need to get the knowledge, and you can be on your way to start investing. So, for us to really kick off our investment journey, we need to build the foundation. If your foundation is very strong enough in terms of your knowledge, research, it helps to really inform your decisions, taking the right decisions to start investing very, very well. Before you actually start investing, number one, you need to start putting aside some money, saving, no matter how small. Start a small savings for emergency fund. It will serve as a cushion or a buffer for investment, so that when the inevitable happens, you can rely on that emergency fund to solve those problems and not dip your hand into your investment. Also, if you have high interest debt, you should actually strategically take care of it and clear those debts before you start investing, because with high interest debts, the more you delay, the more it accrues or accumulates. And so take care of that whilst before you actually kickstart your investment journey. Number two, guys, you need to take or recognize that not all investments are for beginners. If we as beginners, as we're starting our investment, you need to really know that you don't just jump. There are levels to investment. You don't jump to one investment just because we want to start investing. That's one of the first one. In the first step, I said that we need to have financial education, have knowledge about investments that will inform a decision as a beginner, so that you really know the levels of investing. You cannot skip one level. You need to go according to the level. As a beginner, the first investment level you can actually venture into is investing for your retirement or pensions after you stop working. That should be your first priority as you start investing. The second one, guys, is after you have saved for retirement, you can also start investing in low risk index funds and ETFs. Index funds is it's not really about only funds. It's not about individual stocks, but it's an accumulation, a basket of stocks. So with the index funds, you are actually investing into the market. Instead of buying individual stocks as a beginner, you can buy the whole a part of the whole market. I don't know if that makes sense. So that one is actually a very good way to start off as a beginner. It diversifies your investment and it is low risk, as well as ETFs. The third level is, of course, the individual stocks. So after you really gain some expertise in investing in market funds or ETFs or index funds, you can actually start off with buying individual stocks or shares, a piece, or being a part owner of a company. And the fourth one, guys, is speculative investments like the cryptos. And before you get to that, that means gone you have gone through the mill and you know gone through the different levels. So do not skip and do not start off with crypto when you are starting investing. You will lose all your money. So go according to this level to ensure that at least your money would grow for you. Number three, guys, you have to on this level we have to know that we have to rely less on discipline, on motivation, on effort to start investing. Automatic investments is the way to go. Automate your investments, your, your contributions. And so if this you've allocated this percentage of your income or salary to be automatically transferred to that investment account of yours. Automation is the way to go. Number four, guys, choose simplicity it wins the long term. Choose very simple portfolios. Keep it simple. Don't complicate the whole, uh, investment thing. Just put your money into ventures or things that you understand very, very, very well. Do not just go into an investment because we said we have to invest. Invest in things that just keep it simple. It really helps with the process being very smooth and seamless. Number five, guys. Number five, understanding the different dynamics of market behavior and risk levels. The market always goes up and down, it crashes, it comes back, it always recovers. And so really having a fair idea, coming to that understanding of how the market works, how the market behaves. You would, for instance, when the market goes down, you will not go into the panic selling mode where you sell off all your stocks or your shares or your index funds, you sell them all off because the market has gone down, or you stop contributing to your investment. That is not the way to go. If you really understand the market, you know that the market would, when it goes down, will definitely come back up again. And so it's very important that we have that understanding. And when the market goes down, to actually take the opportunity to buy more investments. I mean, invest more, put in more money. Because let's say, for example, stocks, if the market price has gone down than you bought it, that is not a cue for you to sell that of that investment. But because it's now less expensive, it's at a cheaper price. Even if you invest, let's say $100, 100 cedis, you can buy more stocks or shares compared to when the prices go up. So you should actually take advantage of buying more when the market goes down instead of selling off those shares. Number six, guys, over time you'll be paid more, you have increase in salary or pay and income. And so the higher your salary goes, the more you should increase your contributions over time, because starting off small is a very good way because you have taken the initiative of starting. As time goes on, because we want time to work in our favor on our side and we want our contributions to grow, the more money you have in your investments, the more it compounds over time to actually give you more money to grow your money. And so there's a difference with someone who invests, let's say 100, and someone who invests 200. The one who invests the 200 would be ahead of the one who invested the 100. So the more, the better. Number seven, guys, this would be give us a sense of direction or purpose. Have a long-term vision or plan. Why are you investing? Are you investing for retirement, for being financially free, retiring early, buying a home, taking proper care of your children? There should be a why to which you are putting or you are starting your investment. Having that initial clarity, understanding why you are doing it in the first place, it will really go a long way to serve as a motivation, to serve as direction for you so that you keep going when you don't want to do it anymore. There's sometimes you want to give up, but that reason, let it be strong enough to keep you keeping on. Number eight, guys, treat investments like a habit. It's a non-negotiable. Treat it like how you treat your bills, how you pay off your utility bills and all that. If you do not treat it like that as a habit, non-negotiable, you do it automatically without thinking. It really helps with the consistency and compounding over time. When I guys stop trying to time or predict the markets, there's nobody on this earth who can actually do that successfully. You can speculate, but it doesn't mean you would actually get it or you be on point in terms of your predictions. And so, like the dollar cost averaging, put in that investment. You said that you're going to contribute 100 cedis, dollars, rands, naira, pounds, whatever currency you spend, yen, every month. And so you automate it, and you do it no matter what happens, whether the market goes up or down. You're still putting in that investment. It's going to go a long way to help you in the long run. Instead of timing the market and waiting for the market, so really doing what before you put in or you contribute, you cannot do that. So just do it anyways, whether the market goes up or down. 10, guys, build wealth quietly. I mean, wealth building, it's actually a very, very slow process. Maybe sometimes it can take 5, 10, 15, 20 years. If you start investing now, before you will actually see growth, very monumental, significant growth, it will take you like probably 5, 10, or 15 years before it actually starts making sense. In the initial stages, you are not going to see any progress or any growth, and so you might be tempted to give up along the way. But compounding, it really goes with time. You need to be patient and actually be consistent in doing what you are doing for a very long time before you see progress or you see wealth. And so wealth creation is a gradual process, it's a very slow process, it takes time. So you should have that understanding and not give up on the way, because you definitely would see some progress, some increase, some good in some years to come. But do not give up. Of number 11, guys, avoid some mistakes that most beginners make, that does not help them to start investing. Some beginners, like I said in the previous point, they are not seeing any growth, and so they quit too early, they stop investing. Also, follow get rich quick schemes, and all these are ways of losing your money. Beginners also very complicate the whole investment process, or the kind of assets they acquire. The asset classes are quite, or portfolios are quite complicated. Keeping things simple, it really helps a lot. And so avoid all these mistakes that some beginners make so that you can be consistent. Guys, create a personal wealth plan for this year. Like, how much are you going to be contributing consistently? How often? Is it weekly, daily, monthly? There should be a plan that you actually be doing it this often. This amount is where you're going to start contributing. And where are you actually putting those investments? Are you going to buy stocks? Are you going to buy treasury bills, bonds, mutual funds? All these things should be very clear in your plan. What do you want to put your money? How much do you want to put, and how often do you want to contribute? How consistent do you want to be? You should have clarity when it comes to all these questions. 13, guys, is for you to, like I said, be financially literate, do your due diligence of researching, and choose a broker, a licensed broker in your country of abode where you're living. What are some of the brokers, licensed one? So you should actually do your research and research on these brokers so that you make sure they are licensed to actually do it, and you automate or transfer automatically your contributions every month, every week, how often you want to do it to these brokers. It's important that you do your research very well before you put your monies into these brokerage firms. And finally, you need to have the understanding that, like I said earlier, wealth creation is a gradual process, and so it doesn't happen overnight. It doesn't happen suddenly. It takes time. Uh, be patient to actually see good incremental growth over a long period of time. Guys, if you enjoyed this content, can you give me a massive thumbs up, subscribe, like, and share. Do well to check out my previous videos and watch out for the next one. The Lord bless and keep us all. Goodbye for now.